There is a product and a company that offers that product that I'm very bullish on. The product is health savings accounts, and they are extremely beneficial from a health plan, tax benefits, savings, and retirement standpoint. HSAs are still widely underused and misunderstood. So in this video, I want to share why HSAs are something everyone should consider, and I even invested in a company that administers HSA accounts called Health Equity. That's the company that offers health savings accounts. And they just released their earnings, so I will cover that and how it's doing in my own portfolio, this investment of mine. But first, let's talk about and cover health savings accounts. Now, health savings accounts were created more than 20 years ago, and during open enrollment season, employees tend to overlook HSAs, and that's a mistake. Now, they are becoming more popular, but something that a lot of individuals really need to consider. Now, health savings accounts offer something unique. It's a triple tax advantage account. Triple tax advantage account. I'm going to repeat that twice because you have to really focus on that. When you put money into the account, it's tax deductible or pre-tax if your employer lets you make a contribution via payroll deduction. The money grows tax-free, and you don't pay tax on withdrawals at any age as long as you use the money for qualified medical expenses. But there's a bonus: once you reach a certain age, you can just use it as another retirement account. So it's very beneficial when it comes to the tax side of things. Now, some suggest HSAs have quadruple tax advantages because when you make contributions through payroll deduction, your employer avoids payroll taxes. The common confusion I see is people think FSAs, which are flexible spending accounts, and HSAs, which are health savings accounts, are the same thing, but they're not. Flexible spending accounts are mostly use it or lose it every year, so whatever money you set aside, you have to use it by the end of the year. Whereas health savings accounts offer flexibility, and your balance rolls forward year after year, and that is your money, you own it. To me, the best part about HSAs, this is where I'm really bullish on this product and the company, is that you can invest the money you save in your health savings account. You will have a list of investment funds you can choose from. Above a certain dollar threshold, your money gets invested. So what I mean by that is a lot of these accounts, they require you hold, let's say, $2,000 in cash, but anything above that you put into this account, you can invest it. It's pretty awesome. This is an investing channel. This helps us get more wealthy. This is something you need to consider. Now let's talk about the contribution limits. In 2024, they are $4,150 if it's just coverage for yourself, and it's $8,300 if you choose the family health care coverage. Now, those age 55 and older can make an additional $1,000 catch-up contribution each year. And then this year, this coming year, 2025, the contribution limits did increase, and they increased by $150 to $4,300 for individuals, and they increased by $250 to $8,550 for families. So yes, you can put a decent amount into these accounts each year, not as big as an IRA or 401k, but like I always say, long term, the snowball effect happens, and these can become pretty sizable accounts. Now, you do have to have a high deductible healthcare plan to set up and contribute to a health savings account. And you cannot be a dependent on someone else's tax return or a Medicare enrollee. So your high deductible health plan will still have a deductible and a max out of pocket. So don't just think that you're not covered, or you have, some kind of, if something bad happens, that you're going to be on the hook for tens of thousands of hundreds of thousands of dollars. No, it's still a health plan. So, for example, you pay 100% of medical expenses up to your deductible. And of course, those expenses are negotiated by the insurance company and stuff. So you're not paying the full $10,000 bill you get. You might be paying $2,000. But yes, you'll pay 100% of those medical expenses up to your deductible, instead of a copay situation, which is the non-high deductible plans, your typical insurance health plans that everyone's pretty much familiar with. You don't have those copays. You just pay 100% of those expenses. Now, once you do reach your deductible, your medical expenses may be covered 30% at that point. So that's just an example. Each plan's different. So you reach your deductible, you paid 100% of those bills you get in, and then after your deductible, the insurance company says we'll cover 30% of those expenses going forward until you meet your max out of pocket. Then everything's covered from that point on. You don't pay a penny. So the way to plan this to maximize your savings is invest your money that you put into your HSA and let it work for you from there on out. Don't touch it. Now, less than 10% of health savings account owners invest their funds. So those that have these accounts, 90% do not invest. And that's not good. We need to get the word out because more people need to take advantage of this. So these people typically also withdraw the money regularly to pay for qualified medical expenses. As a result, they never build a sizable balance in their HSA. They still gain some tax benefits, but they lose out on tax-free growth over time, and that is just a beautiful thing to take advantage of. So if you can afford it, do not reimburse yourself from your HSA. Instead, pay for it out of pocket from a different source of savings so that you can grow your HSA investment and have some good gains and growth long term. I know that seems counterintuitive, but it's actually smart to do it this way. And about 50% of people with HSAs have less than $500 in their account. So like I said, I think that's half the battle. Is you usually have to reach a certain dollar limit before you start investing. But if you only have $500, that also poses the problem if some big medical expense comes and you can't cover it. You only have $500 to work with in that account. So you could also look at it as, okay, well, I'm just going to hold cash, and you could earn some interest on that cash because that's possible with these HSA accounts, but it's not a lot. Most HSA custodians are paying low interest, typically under 1% on cash, and monthly account fees might exceed the minimal interest paid, leaving account holders with slowly eroding cash balances. That's why you want to invest, not just hold cash all the time. And that's why it's important to know what that threshold of that account is, because I've heard of $2,000 you have to keep in cash. Anything above that you invest. So you can really focus on maxing out your HSA. That's what you want to do every year and get it to the point of investing. So use your HSA investment as a tool for long-term growth. For those with enough money to invest HSA funds, the benefits accrue. Some accounts offer access to wide-ranging opportunities from an HSA investment, including ETFs, which I like, that provide instant diversification. Other HSAs offer a brokerage option, allowing holders to invest in stocks. Some also have covered call options and money funds, as well as real estate, private loans, and precious metals. I recommend low-cost, diversified funds. Pay attention to those expense ratios, though, right? We always talk about that. And what the fund charges you. I always like an S&P 500 ETF. That's just always the best bet, especially if you are younger and can really take advantage of that growth of the market. Now, HSAs are best for high income earners, healthy individuals with fewer current medical expenses, and those looking for tax-efficient retirement strategies. These are the individuals that are best positioned to benefit from HSAs. And it makes sense because high income earners can afford to pay out of pocket for their medical expenses and max out those HSAs. Also, if you're a healthy individual, you're going to go to the doctor less. That's less money out of your pocket to pay for those expenses. And if you are really focused on building your nest egg, using this as a retirement account, and if that's your goal, this is who this is best meant for. You know, me and a friend built out a worksheet because I'm an accountant. I love Excel. I'm a nerd like that. And we figured out at what point is there break even? Is it better just have a normal healthcare plan? And really, for most situations, the HSA wins. So really try to analyze and think about your situation, what expenses you might incur each year based on your health, et cetera, and your income. So it really is such an attractive retirement account if you let it run and take advantage of the long-term growth. By investing your HSA funds and letting the money grow, you can retire with an added layer of financial security. Unlike an IRA or 401k, there is no mandatory distribution requirement with an HSA, so you can let the investment keep growing well into your 70s and beyond. But hopefully you take advantage of these funds so you can live life in your retirement years. So overall, you can invest in your HSA and create a tax-free retirement and medical expense account. A tip, be sure to save medical receipts now and reap tax-free withdrawals later. So keep records of all your medical expenses over time. If you need or want to pull out money, you can use those medical expenses, the receipts that you saved, to pull out the funds without any penalties. So for example, let's say 2 years of medical expenses, you saved all your receipts and it's $10,000. You can then turn that into your HSA administrator and say, okay, I want to be reimbursed for this $10,000. And then that $10,000 is yours. You can do whatever you want with it. You can put it towards buying a new car or something. So that's something to keep in mind. But I highly suggest you just leave it in there for long-term growth instead. Now, those who are self-employed can also use HSAs. So if that's your situation, just look into that. Now, as you can tell, I love health savings accounts. I think they're a very smart savings and retirement tool. So I also thought I should invest in the leading HSA administrator. The company is Health Equity. This is a new holding of mine this year, and it has done awesome for me. I will show you the proof when I share my portfolio in a little bit. Now, my main thesis behind this investment is that HSAs will grow in popularity and Health Equity will benefit massively from it. Health Equity makes money by collecting fees, and that's a great revenue structure for a company to have. It's that toll booth effect that Warren Buffett loves. This company just sits back and collects these fees month after month. It's pretty dependable, and they grow as this product and service grows as well. So some of the fees are investment and administration fees. So Health Equity charges a monthly fee to invest in funds. There's interchange fees, which Health Equity earns interchange fees when debit cards issued for Health Equity HSAs are used. So you get a debit card, so that way you go to the doctors, you can pay from, with that card, it takes money out of your HSA. Again, try not to do that. The plan is to just invest and leave it alone. But they get a little fee from each swipe. There's some other ways they get revenue from fees. They also have a subscription you can buy. I looked into it, but I've done some deep dives into this. So I'm going to talk more about now their earnings that they just released. Now, revenue increased 21% year over year to $300.4 million. That's an all-time high for Health Equity, and 21% growth year over year is very healthy. That's pretty fast growth. I love to see this. Now, long-term debt is at $1.08 billion. It came down just slightly from last quarter. This debt is a little high, but I will tell you, I am not worried about it. This debt is created because they've done some acquisitions in the past. This is how these small companies grow, so they're doing what they need to do. I'm totally okay with this. Net income came in at $5.7 million, and you'll see it drop pretty significantly from last quarter. But mind you, we're not talking about revenue where it's hundreds of millions of dollars. This is, from about 36 million down to about 6 million, and year over year it did decline. But this was due mainly to expenses related to the merger of the other company, Benefit Wallet. So they did an acquisition, so they have more accounts now. They took in all their accounts and expanded their customer base. So this to me is a good thing, not a bad thing. That's okay it dropped due to this merger, and this is going to position Health Equity to really benefit long term and grow that much more, collect more fees, etc., etc. Now I'm going to show you my most favorite thing from the earnings. This is the total HSA assets, which include cash and investments. So what people hold in this account in cash versus investments. Now collectively it grew 33% and is now at almost $30 billion that people are holding in their accounts. Of that, you'll see HSA investments grew 58%. That is amazing. And I'll tell you why. When people invest, what do? They plan on keeping that money in there for long term, which means Health Equity has some solid, predictable fee revenue income going forward, and it's going to be growing and growing because this shows me that people really are looking at this as an investment tool, and they're increasing massively what they are putting in to invest. But also cash is going up 17%, very good as well. But this is beautiful to me. This is why I am so bullish, and I think this is being overlooked by analysts. Now, if we continue on, we'll see here that the total accounts. So, I opened an account, that's one. So HSAs increased year over year by 15%, and there's now 9.5 million accounts that Health Equity has. That's beautiful. Total accounts overall went up 8% because they do have some other products besides health savings accounts. So this company's doing really well. Now, a few extra things to mention. I talked about that over $1 billion of long-term debt. And the reason why I'm not worried about it, other than they're putting, they're doing mergers and acquisitions, so they're taking out some debt for that. That's totally acceptable to me. That's them expanding and growing their business. But also, the balance sheet is healthy. Assets are more than double their liabilities, almost triple their liabilities. And so that shows that they have a healthy amount of assets to offset that long-term debt. So to me, this is great. Now, if it was assets were pretty even with liabilities, that's when I'd be a little worried. But no, they are doing this in a very responsible manner. Also, we know who the new administration is going to be, right? It's going to be a Trump administration. And he in the past and has signaled recently that he's more favorable of health savings accounts. So I see it as the next 4 years could allow Health Equity to really boost their presence and adoption of health savings accounts, further cementing their future success. So that's a good thing. And then I also, going through their earnings, saw that they mentioned there will be a CEO transition in the future. So I'm going to keep my eye on that because good management and the whole management leadership team, especially the CEO, matters. And so I'm definitely going to follow this, and I'll update you guys if there's any news about it. And then I want to talk about last earnings. So 2 earnings ago, shall I say, they announced a stock repurchase program of $300 million. So I wanted to see this earnings that they're buying back shares, and they are. The company repurchased 0.7 million shares of its common stock for $60 million during this last quarter. And that means they have $240 million left to repurchase shares under this program. So they're doing what they need to do. This is adding value to us shareholders. There's 2 ways that they can return value to us. That's through dividends and through share repurchases. And I love to see that. Shall I say they're returning profits back to us. And then they also raised their fiscal 2025 guidance, and they provided a healthy and initial outlook for fiscal year 2026. And if we look at the stock chart here, you'll see over the last year, this stock has done excellent. It's up 46%. Now, after earnings, it did drop 6%, and that's because Health Equity expects fiscal 2026 full year revenue. So we said end of 2025 is being raised and the beginning of 2026 looks good. But the full year revenue for 2026 is going to be between $1.275 billion and $1.295 billion, and analysts were expecting $1.315 billion. So they're coming in a little lower, but Health Equity had a very strong third quarter of results, as we saw, so I'm not worried. This company is growing in all the right areas, and I remain bullish on this company long term. I think what they're setting up now is going to create some explosive growth opportunities in the future. So how is my investment in Health Equity doing? Well, let's take a look. First of all, my portfolio is up about 36% in the green. And I will say real quick, a spotlight on Amazon because it sticks out like a sore thumb in a positive way. It's providing me 107.77% of returns of growth. This is amazing. I'm in the green over 100%, the first stock to do that for me, and I'm still very bullish on Amazon. But if we go to Health Equity in the opposite corner, the bottom left, we'll see it's in the green for me, 25.35%. And I have owned this stock less than a year. I bought it, I think, in about March or April of 2024. So this is very good growth for holding the stock less than a year. And I feel long term, it's going to be in the Amazon position where it's up over 100% for me. And I'm hoping that will be the case in about 3 years. I really think these health savings accounts will accelerate fast. So let me know if you have any sleeper stocks that others are not really talking about that have performed well like Health Equity has for me. Health Equity is a stock I found, analyzed, and researched on my own. I didn't get any ideas from any other YouTubers or social media influencers. I looked this up on my own by knowing this product somewhat, and it turned out I really liked everything I saw about it. Now, no one else on the internet is talking about this stock, none of the big YouTube names, so that's why you should follow multiple channels to capture more than just the trending stocks. You can also find those gems that are not hitting the spotlight yet. So please consider joining my channel, subscribing to it. This is an investing family, and we are all here to help each other become wealthy. So I will say, consider these health savings accounts. And then also, I think Health Equity is a pretty good investment. And that's all for today. Happy investing, and we'll see you next week on Mark Arnold's Finance.